Well, for more on what's moving markets, I want to bring in Thomas Hayes. He's a chair and managing member of Great Hill Capital. Joining me on set, Thomas, welcome.
Glad to be here.
Yeah, we're happy to have you. So it looks like stocks want to move higher.
Yeah.
What's your take on the market?
Mixed message of the markets, Kristen. What we've seen is markets can correct in price or they can correct in time. And in the last 5 weeks, you've seen the NASDAQ and the semiconductor index, which were very hot, actually have zero gains. So they've been grinding sideways, consolidating gains, while the S&P 500 and the Dow were actually up during that same period. I think we're in an information vacuum. We've had this 27% rally off the lows in October, and we're kind of waiting for the inflation data that you referenced and the beginning of earnings season.
Interesting. Now, what's your expectation for earnings?
Okay, that's an easier question than inflation. Earnings, they've set the bar low. So expectations were 5.7% growth at the end of last year. Now it's down to 3.2%. So I think we'll see probably better than expected earnings with the bar taken down. The key is going to be guidance going prospectively.
Yeah, it is interesting that these companies certainly do seem to be very optimistic and generally bullish, right? If their balance sheet is in a good place, despite what has been persistent inflation, and we'll get that read tomorrow, that first read, at least for consumer prices. So what do you anticipate for that?
Okay, so there's one school of thought that thinks that the aberrational seasonality of January and February will come out of the numbers, and the lag in owner's equivalent rent will come out of the numbers. That lag will be gone. In which case, we would get a better than expected number, meaning lower than 0.3% on core and regular CPI, headline CPI. In which case, that would be interesting because we've had this counter trend rally both in the US dollar and in yields. As you know, yields have been going out. If that is the case, what we will see is a compression of yields. Bonds should start to rally. US dollar should start to weaken because it opens the door for the Fed to legitimately be cutting in June. That's also critically important because the Bank of Japan has stepped out of the global liquidity backstop game now that they've started to be more restrictive and they've stopped with their yield curve control. So the West is going to have to pick up the slack for liquidity, ECB, Fed.
So it sounds like that is optimistic for stocks.
I think so. I think so. It wouldn't surprise me to see a little 3 to 5% pullback. I'm willing to be wrong on that. We've got a 2% equity hedge, both in semiconductors and the S&P, but we're 98% long. So really the opportunity is not chasing the indices that have been up 27% off the lows, but actually under the surface to find unique, discrete opportunities that have lagged a little bit behind.
What do you see as some of those opportunities? Yeah,
I've got a really interesting one that no one ever talks about called GXO Logistics. This is one of Brad Jacobs' companies that was spun out of XPO Logistics, and they focus on warehousing, distribution, order fulfillment for companies like Red Bull, Nike, LVMH. They've got about $10 billion of revenue, which is only 2.2% of the total addressable market, which is $450 billion. They generated over $500 million of operating cash flow, $300 million of free cash flow. And get this, Kristen, for every incremental dollar that they invest in acquisitions or in their business, they're getting back 30 cents. So over 30% return, operating return on capital. And I think this is going to be a compounder. It's an acquisitive platform. They're going to roll up a lot of these businesses in a fragmented sector. And I think you're going to see over the next couple of years, the stock is down 50% off its 2021 highs. I think you're going to see a nice recovery over a period of 2 or 3 years.
Interesting. Okay, so that's definitely a stock pick that's on your radar that you're bullish on. Any other stocks or even sectors that look attractive?
Yeah, I got one other. I mean, this one is about the least amount of research we've ever had to do on a stock pick, and that's Boeing. And as controversial as it's been and as kind of nonstop parade of bad events, they still operate in a duopoly. So if you're an airline and you're Southwest and you say, Boeing, I've had enough with all these problems, yes, they're replacing the CEO, that's good, but I'm going to Airbus, you're going to wait 20 years for your next plane. They delivered 528 planes last year. They've got 5,600 plane backlog. So with the way the stock is sold off, we think it's an opportunity if you can take a long-term view, 12, 24, 36 months, beyond this short-term headline noise.
So how do you, though, make sense of that noise, right? Because it does seem like it's just headline after headline, the most recent one being the Southwest plane impacted taking off from Denver Airport.
Yeah, well, the good news is you got a new sheriff in town, so that'll be positive. And the better news for owners of Boeing is that there's nowhere else to get planes. So demand is growing, supply is lackluster. They're gonna figure it out, and Boeing will be a good beneficiary. To your point on sectors, as it relates to the inflation numbers, if the Fed gets involved in the game, interest rate sensitive sectors are going to start to perform. Small caps need the help of lower rates. Yeah. REITs need the help of lower rates. Utilities need the help of lower rates. So I think there are some opportunities there in groups that haven't performed that if we do get the inflation numbers, they'll start to perform now. If we don't get the inflation numbers, we'll have to wait another few months.
I think it has been challenging for investors, especially I would say in the past 10 days or so, right? PCE data that was pretty much in line, stronger than expected jobs report, comments from the Fed chair, other Fed officials, including Neil Kashkari.
Every day, it's a new thing.
Right,
it's a circus, is really what it is. You know, one day you've got the guy coming out with no cuts. Next day you have someone saying 3 cuts is our base case. Bullard came out recently and said 3 cuts is the base case. So I think that they don't have as much time as they think they do to be data dependent with the BOJ stepping out as liquidity provider. Because remember, while the West was tightening for the last 2 years fighting inflation, BOJ was not only buying global bonds, they were buying global equities through ETFs, and that's no longer the case. So unless they're interested in a liquidity shock, they're probably going to have to move a little faster and certainly well before 2%.
3 rate cuts, you think that's... We're starting to see some of that repriced in the market, more like perhaps 2 rate cuts this year.
Yeah. The earlier they move, the less they'll have to do. That's the name of the game. So if they move in June, they might get away with 1 or 2 because they're being proactive. If they're reactive, they may have to do a lot more, and it'll be a lot more costly. So I'm encouraged that they can move the first one in June, in which case I think 2 would be in line, something like a 1995 mid-cycle reset. If they press it too long, maybe either because of the election concerns or other, and don't move quickly enough, it could be 3 or more, and then we face a harder than a no landing.
You know, I think some people would say that Powell was behind the curve, right?
Yeah.
Certainly in September of 2021, calling inflation transitory and then embarking on the most aggressive rate rising several months later that we had seen in decades, right? And so based on what market participants, you as a professional, have observed of Chair Powell, what do you think actually happens?
Yeah, that's a good question. I mean, starting with December 2018, I don't know if you remember autopilot and the market crashed right before Christmas. So I'm skeptical. He has historically been behind the curve. He's caught up, so you have to give him credit. He has caught up this time. He is recognizing the two-sided risk of not moving as well as not reigniting inflation. I'm going to give him the benefit of the doubt and expect that he will be proactive versus reactive. And a lot of that's going to depend on the near-term data, which we're going to get a lot more tomorrow.
So where does that put us in the cycle? I heard you mention earlier, perhaps mid-cycle, just for anyone who is thinking more long-term, right? 12, 20, 18, 24 months out there.
Yeah, I'm very constructive. I mean, short-term, I wouldn't be surprised if we get a little bit of pullback, maybe some type of earnings results or something. But certainly intermediate term, 12 to 18 months, we're going to be higher. And if you take a look at the secular, I think we're halfway through a secular bull, and that's predicated on millennials being the largest part of the population, age 33. They're going to spend until they're 40, and the market's going to benefit.
Okay, very good. Thomas, anything else we need to know? It's been a while since you've been able to make this work on set.
Well, I'm happy to be here. I would just say that any drop that you see, the money is going to be made under the surface. So you don't want to chase the shiny objects that everyone likes to talk about every day. Look for the companies like the GXOs, like the Boeing, that are out of favor, but you know are high quality businesses. For instance, Disney, when it was down in the low 90s, everyone knows Disney's going to be fine, right? And now it's up at, well over $100 and climbing. So businesses like that are not being chased, that are a little bit out of favor, but durable, high quality for the long term, that's where we want to be focused.
All right, Thomas Hayes joining me on set. He's the chair and managing member of Grayhill Capital. Thomas, thank you.
Thank you for having me.